Welcome to The Explainer. Today, we're tearing down the hidden mechanics behind modern mega IPOs. We're going to contrast all that wild speculative hype with the actual disciplined strategies that build real long-term wealth. Let's get right into it.
So let's just jump right into a pretty provocative question. Who exactly is eagerly lining up to buy a massive aerospace business that lost almost $5 billion last year alone? And honestly, more importantly, why is the financial system seemingly rewriting its own rules just to make sure you are the one buying it? Brace yourselves for this number, because SpaceX is targeting an eye-watering $1.75 trillion valuation for its IPO. To put that massive scale into perspective, that makes this single company larger than all American defense contractors combined. We're talking bigger than Coca-Cola, McDonald's, Disney, Nike, and Starbucks all put together. This isn't just an IPO, it's a financial leviathan.
The sheer scale of this illusion is honestly fascinating. It's so easy to get swept up in the whole romantic narrative of colonizing Mars. And sure, the company did bring in a very impressive $18.7 billion in revenue last year. But beneath that top-line hype, they're masking a massive annual loss of nearly $5 billion. So how does a company lose that much cash while totally dominating the space industry?
Well, to figure that out, we've got to look under the hood and understand the three totally distinct businesses operating inside SpaceX. First up, you have Starlink, which is a wildly successful satellite internet provider, driving about 61% of their revenue. Then there's the famous Rocket division, which is super solid and holds massive government contracts. But then you have xAI, an artificial intelligence lab that SpaceX recently absorbed.
And right there is the massive internal tug-of-war, dragging their numbers down. On one side, Starlink is a literal cash-printing machine. It's got incredible, accelerating profit margins, hitting 63%. But look at the flip side. Those profits are getting completely wiped out by xAI. We're talking $12.7 billion committed to hardware in a single year, and they burned through $7.7 billion in just one quarter. The profitable internet business is basically just funding a massive speculative AI bet.
Now, take all of that and mix it with what is basically a corporate governance nightmare for the everyday investor. Elon Musk holds roughly 85% of the total voting power. In fact, their own filings explicitly say SpaceX operates as a controlled company. What does that mean for you? It means public shareholders have virtually zero say. This is a setup where the board can just approve spending $131 million of SpaceX funds to buy Tesla Cybertrucks at retail price, and literally nobody can stop it.
But here is the kicker. Here is where it directly hits your wallet, even if you never consciously buy a single share. The NASDAQ quietly changed its rules for mega-cap companies. They introduced this new fast entry rule that lets companies into the NASDAQ 100 index in just 15 days, down from months of normal price discovery. They also dropped the minimum public float requirement, meaning SpaceX can join with just 4 to 5% of its shares available. And most shockingly, they added a hidden multiplier that treats that tiny float as if it were 3 times larger.
Why does this matter to you? Well, because of these newly engineered rule changes, if you have a 401k, a pension, or an index fund like the QQQ, you're going to be forced to buy SpaceX at its absolute peak valuation. The passive funds have to track the index, and the index is rewriting the rules to welcome SpaceX. As portfolio manager George Noble so bluntly puts it, your 401k is the exit liquidity for the early investors.
To really get why this is so dangerous, you need to understand something called lockup expiration. Basically, this is the restricted window right after an IPO when early insiders are legally banned from selling their shares. But the second that date hits, which for Elon Musk is 366 days post-IPO, insiders are finally allowed to just flood the market with their massive, cheap shareholdings. And historically, this huge surge in supply absolutely crashes the stock price, leaving retail index buyers holding the bag.
So, how do we dodge this passive investing trap? We have to completely flip our mindset. We need to step away from the flashy hype of orbital data centers and Mars colonies and focus strictly on one thing: the vital difference between what a stock costs and what the underlying business is actually worth.
Just look at how absurd this hype gets when you compare the multiples. The market is asking you to pay roughly 90 times revenue for SpaceX. That is a massive speculative premium for a company burning billions in cash. Now contrast that with Google, a proven, highly profitable, totally dominant tech giant. Google trades at just 11 times revenue.
You really have to ask yourself, are you just paying for future potential that's already been priced into absolute perfection?
And that brings us to the holy grail of fundamental investing, intrinsic value. This is a rigorous, hard math calculation of what a company is truly worth, based entirely on its real ability to generate future cash flows and maintain its profit margins. It completely ignores all the media excitement, the FOMO, and the promises of shiny new tech that, as SpaceX's own lawyers admitted in their filings, literally do not currently exist.
Let's just put these two things side by side. Speculating is buying into a multi-trillion-dollar story, completely ignoring massive cash burns, and just crossing your fingers that it pays off decades from now. True investing, on the other hand, is evaluating a mature, cash-flowing business and buying it at a price that gives you a margin of safety. It's about protecting your hard-earned capital, not gambling it.
If you want to see real fundamentals in the wild, a disciplined investor totally ignores the noise and looks straight at the math. Take Meta, for example. They generated a colossal $48 billion in free cash flow last year with a 41% operating margin. Or look at Uber, printing $2.3 billion in free cash flow in just a single quarter with 20% trip growth. These are mature businesses generating massive, real-world cash today, not just promises of cash tomorrow.
Now, what if you're thinking, hey, I don't want to analyze individual companies? Totally fair. Instead of trying to time some highly risky, volatile IPO, a lot of successful investors just use dollar-cost averaging. It's super simple. You steadily invest a set amount of money on a rigid, recurring schedule. This strategy completely takes emotion, anxiety, and the fear of missing out right out of your financial decisions.
For consistent wealth building without the daily heart attacks, our source material highlights strategies like the SCHD ETF. This fund gives you automated set-it-and-forget-it exposure to 100 highly profitable dividend-paying U.S. companies. It boasts a microscopic 0.06% expense ratio and a super consistent 3.3% yield. It's quiet, it's boring, and you know what? It systematically builds capital over time.
So here's the absolute bottom line I want you to walk away with today, straight from our source material. A great story becomes a terrible investment if you overpay for it. You can totally love the mission, and you can admire the incredible engineering, but if the stock price requires absolute perfection for the next 30 years just for you to break even, the math is fundamentally working against you.
So take a hard look at your own portfolio right now and ask yourself this final, provocative question. Are you actively evaluating the fundamentals, the profit margins, and the cash flows of your investments? Or through passive index funds and IPO FOMO, are you just blindly letting your money fund the hype? Thanks for hanging out with me on this explainer. Keep focusing on those fundamentals, and I'll catch you next time.